Wow. Everyone stand up, please. Okay, let's put our hands together for Scott and Chad because they've done such a wonderful job. Fantastic weekend. It's great to see so many capitalists assembled in one location. And also, please don't sit down yet because I want you standing when you see the next slide. Okay? We all have been around since 2008. I mean, I was listening to a Rocky movie a couple months ago, and it's so true. Is the audio on, Chad? Okay. It really makes sense what he says. I mean, since 2008, it's not, the measure of a man is basically not the punches he delivers in life, but the punches he takes and remains standing. So, so you're all standing, so great. Thank you. I have to say that these guys have put together a great team. I've been involved in prior models of people attempting to do the same thing. These guys have really come together with a team approach. They're concerned with all the necessary ingredients for a successful investor. A lot of the prior models, they were concerned with just simply dealing with the model that was the successful student. But the entire mission in this business is basically a successful investor. And Chad and Scott have put together a team of people working for them in many areas. One is the site selection, two is the construction end, three is the property management, and also four is basically the financing. They're putting together teams that get financing. This is all critical to a successful investor. Also, in terms of the investors I've met over the last day or so, I mean, you guys are all doing it. It's great. I mean, and there's power in numbers here. It's just a fantastic experience and what's happening here. One of the things that I noticed that when Keys to Retirement was formed, one of the things that was always a concern was basically the methodology in bringing the investor from the education stage into the investing stage. And so often that after they completed the coursework, they went from the coursework into some wholesalers that were basically dealing with, were selling them bad deals, contractors that basically were running with the money. But these guys are now, with this team approach, they're basically overlooking them, and they're in a project management role, which basically has been very successful. Now, the one thing that is coming back, and I think everyone should take advantage of, is these courses that they're holding, these refresher courses. I mean, it's blocking and tackling again. It's going back to basics, running through some of the coursework that you were previously involved in, and in dealing with it. Two is that these weekends are unbelievable. The networking that's taken place is, and the questions that are being asked, and the new ideas coming up. I mean, it's fantastic. And really, what that leads me to is one of the things that Carl Fisher and I were talking about just last night is, in terms of with the number of people that are involved in the program, that there's what is known as a self-directed IRA, which I won't preempt Carl because he's an expert in this area, but we were talking about some of the members of the team here basically lending to other LLCs and lending to other investors through their self-directed IRAs. Most people today, the funds that they're, you're getting 0.5% on your money market rate. So if you can get a 7.5% commercial mortgage, quite frankly, it's a successful investment for the self-directed IRA. Carl and I were talking that we would do Kerr Law would do the paperwork on the deal, and we would do the note and mortgage and close on it, and he would handle it from his end. So there's a great deal of financing is one of the big concerns today, and it's one alternative which Carl will speak in greater detail later. Okay, let's talk about, one of the things that I wanted to go into today was the limited partnerships. And when Chad and Scott were planning this weekend, we were talking about maybe doing LLCs. I speak a lot on LLCs, I speak a lot on tax, and they said, let's do something a little different. And limited partnerships was an avenue that, it's not every deal, but it's something that you all should be aware of. As you know, when you get involved in a project, you're really looking, where are the funds coming from? Either they're coming from your bank accounts, they're coming from maybe a HELOC, if you will, or maybe some financing, or maybe an outside lender. But a lot of times when we're putting together deals, especially bigger commercial deals, we basically bring in outside investors. And the way we bring in outside investors is we bring them in through the, let's see here. We bring them in through what is known as a limited partnership. And the concept is, let's say you had $1 million project that was presented to you, and you wanted to, obviously you didn't have the means to do $1 million, but, excuse me, you had investors that were available to invest in the project. So what you would do is, obviously, you're the person who is the founder of the deal. The founder of the deal would be looking to other individuals that want to invest in the deal. Obviously, as the founder of the deal, you really don't want to be, you really don't want the investors to be actively involved in the day-to-day operations and tenant selection and all that. You just want them to be in a silent role. Well, most investors want to be in that role also. They want to be limited. They want to be, they just want to put their money into the deal. They don't want to have exposure beyond the money that they placed into the deal. And they want to earn a reasonable rate of return. So that's how we come up with this limited partnership. That it's a great concept to marry those two, the deal maker, if you will, with the investors. So with that having said, once we get into a project, and the beauty of this is that each and every one of you could possibly be looking at a deal that's too big for you. But at the same time, as a group, maybe we should offer it to the group and put together a limited partnership whereby we fund it and also we set up the general partner. So, but let me just talk about, from a structuring standpoint, that everyone knows that a limited partnership, or should know, because I've spoken about it enough, is that a limited partnership basically has two types of partners. One being a general partner, two being a limited partner. Now, as a limited partner, you have very limited say on what can take place in the entity. As a general partner, you have exclusive say. And also, the bad, you get the good with the bad. Since you have exclusive say, you have unlimited liability, which means that if something goes wrong within the entity, they can come after you individually. Now, obviously, we're smart enough to get around that. We set up, as a general partner, usually a limited liability company, and that becomes a GP for purposes of this investment. As a GP, you basically control the deal. You basically decide when to buy the property, when to sell the property, the rents charged, day-to-day operations, whether or not you want to refinance or you want to finance for the first place. But that's a key role, and it's a great vehicle to buy larger projects. It's not for the everyday, it's not replacing the LLC, but it's a great concept to utilize when you're dealing with the larger projects. And I was talking to someone in the after-hours party last night, and they had an apartment building, 276 units. And that's the kind of deal that you present to the group here. And basically, maybe we put a limited partnership together, and we all work with it together. Because what happens in this process is that you start out as buying single homes and doing that concept. But as you become more seasoned, you're going to go into the multifamily homes. And you're going to go from the multifamily homes into the commercial. And it's just a necessary evolution if you stay with the process. And let me tell you something, even though I said early on that 2008, since 2008 it's been difficult, what I'm reading now in the national publications is it looks great for investors going forward. Rental rates are going higher. Basically, what's happened is that a lot of the multifamily homes that were being built just ceased in 2008. People got displaced from their homes. They need a place to rent. So, I mean, it's all good. That's all going to equate to higher investment prices. Also, not only higher investment prices, but it should be reduced vacancies. So, if you have a lot of vacancies, you better be looking around for a different property manager because things are looking good. Okay. In terms of the, one of the things that we do when we get involved in the limited partnership projects is oftentimes not only do we set up the limited partnership, but we also set up some companies that deal with the limited partnership. For example, let's say you have $1 million commercial project, you know, you're getting it for $750, and then there's some renovation involved in it. We generally set up a construction company or a developer to deal with the construction end. Also, we could set up a property manager. So there's a lot of different vehicles you can utilize here with the limited partnership. It's a great vehicle. The concern is that when you're getting involved in this process, you really have to, what we generally do is as a promoter in the deal, is we start out with a worksheet. We start out with a spreadsheet. Let's look at the deal. And let's see what kind of income there is. Why are we getting into the deal? We're getting into it for upward potential. We're getting into it for rental income. And just get our arms around the deal. Because that's going to be so important in terms of making the allocation or making the allocations for in partnership agreement. For example, back in the late 80s, early 90s, we were doing LPs for shopping centers, strip malls and things like that. So in those deals, basically, we saw that there was rental income capacity, but also we knew there was upward movement on price. So a lot of the deals we structured, we basically structured all the income flow, and also we looked at the end result, 10 years out as to the price. So a lot of times what we would do is we would make a 1/3, 2/3 allocation. We would allocate 2/3 of the income to the limited partners and 1/3 to the GP. But on the ultimate sale, we would flip that. We would say that on the sale of the property, we would get 2/3 to the GP and 1/3 for the limited partners. It was a great marriage because a lot of the limited partners, they were looking for deals that basically gave them income, which we were giving them the bulk of the income. And at the same time, on the sale, the promoter was saying, hey, I got a great property. I know how to go in and rehab it and get it started. I know it's going to be worth a lot in 10 years because I'm going to get my rents up. As a result, it's going to increase the value. So it was a great concept that worked. Now, this same can be applied to any of the residential deals you're doing. Let's say you want to put the team together to do maybe 5 or 6 of these places you're currently looking at. I mean, and you have to look at the income flow, the back end, if there is a back end, and make that determination. Now, that's the financial end of it. Now, what we do from that is that where we go from there is to look at what comprises the limited partnership agreement, which is basically taking all those financial terms and incorporating them into the partnership agreement. The critical elements, again, is contributions of capital. I mean, a lot of these deals we structure, we give the GP 25% interest, 0 capital in. He found the deal. He's basically the mover. And 75% to the limited partners. So in that, this agreement that's probably 35 pages long, basically we deal with the issue of capital contributions. What if there's additional capital that's required during the project? Sometimes our cash flow is not adequate. So, we have to deal with the capital calls, as we call it. If a limited partner can't make a capital call, then what happens is that do we reduce his interest? Does he forfeit his interest, or what? So these are all terms that go into the legal documents that carry the deal. In terms of the allocation, what happens from a taxation standpoint with limited partnerships is that it's treated as a pass-through entity, meaning that you'll get a K1. If you're a limited partner, you'll be getting a K1 that's reported on your personal return. The allocation has to be in accordance with 704B regs, and these are very detailed, complicated regs that need to be put into this agreement. Now, for example, like in the early years, if you have losses, a lot of times, as I said, the GP has zero capital, but the limited partners put in all the capital. Under the 704B regs, those losses the general partner will get none of those losses, whereas the limited partner will get all those losses. So that could be a positive thing, and that's part of the deal. In terms of distributions, how are we distributing out to the limited partners? Are we going to set up a formula? Are we going to say they get X% each year? Or that's all part of the negotiations and putting together the deal. Also, a lot of times what we do is we actually put a formula approach in there. We define, how much should be left for replacement and escrow for operating, etc. And you can go into detail. This is all a matter of contract between the parties, and you can define it in infinite detail. Okay. One of the great things, and again, is I don't know if you've ever, obviously a lot of this stuff could be incorporated into an LLC, but we've always used LPs in the past. But one of the things on the general partner is that they have exclusive control. Now, sometimes, depending on the limited partner group you put together, they may certainly try to have some sort of control over the GP. And oftentimes, the way that is set up is that if a certain percent of the LPs decide that the GP should be removed, then that can take place. But generally, we try to give the limited partner relatively little power to remove the GP, but sometimes you'll find that that's negotiated as part of the deal. Like I said before, the general contractors and property management company, when you're doing bigger deals, you can actually have a contractor. You can set up a construction contract and be the GC to do some of the renovations on the deal, as long as it's disclosed within the document. In terms of property management, you could, could potentially set up a property management company. Obviously, you have to look at the state law that you're involved in. One of the final, I'm just trying to give you some of the operative provisions that are critical in any of these deals, is that restrictions on transfers. And that's what that is about what if one of the limited partners die? What happens in that situation? What if one of the limited partners wants to sell his interest? What happens then? And some of the issues that arise, those are provisions that you try to you put into this document and try to preclude, very few transactions where limited partners are bringing other limited partners in. Also, the amendment of limited partnership, what we generally do in our documents is we basically provide that their amendment can be made by the general partner from time to time. A lot of times the limited partners will try to restrict that, but we try to give as much power to the GP as possible. Okay, now what we've done is we've gone through looking at the deal. And like I said, the intent here today is not to make you an expert in limited partnerships, because it's there's volumes written on the subject. It's and the first step in doing this is put together the deal. See, first of all, does the project make sense? How much income are you realizing? Are you in it for the long term? Are you trying to get the back end to determine the allocations, etc.? The second thing is then identify your investment group and identify who's going to be, who you're going after. And the third is once you have that investment group, then you're putting together an agreement that's going to be circulated to the investment group. And along with that becomes something very critical, and a lot of people don't realize this, but a limited partnership interest is what is known as a security. And as a security, you're subject to the federal securities laws, and also in this state, Maryland securities law. In those laws, every security must be registered unless there's an exemption. And but in Maryland actually uses the same exemptions as the Securities Exchange Act of 1933, and specifically rule number 505 and 506. But also Maryland has this, they're trying to induce people to come in and buy, get involved in projects and investments and things like that. They have this Maryland small company offering, which is a great exemption. It's called SCORE. No, it's not what you're thinking, Mr. McDonald, but it's a good way to raise money on the state side, and basically you can raise up to $1 million with relatively ease, which is not every state has this kind of provision. What they do require is, one, is if you read with me, shares are not restricted. Two, general solicitation may be used. That means you can speak to open groups about it. Three is that you can't sell more than $1 million in any 12-month period. And the last prong is that you have to file this Form U7, which is a simple form, with the Securities Exchange, securities people in Maryland. So if you're going to be putting one of these together in Maryland, quite frankly, there's easy access, and you don't have to go through registration statements and all. It's a pretty simple process. So I think it's something that can be used, and you have to be cognizant of the securities laws when you're dealing with these limited partnerships. Even LLCs technically fall under the securities law unless you can point to an exemption, and each state has their exemptions, and is very important. So those are some of the important things on the limited partnership. The process starts out is once you want to start forming a partnership, it's almost like setting up an LLC. You file a certificate of limited partnership with the state, and you go from there. And but I think that I know we did a couple deals in Detroit where we wanted to raise some money. It was some housing there that presented itself. It was at a very attractive price, and it was relatively easy to put together a limited partnership, bring in a lot of funding, and it was a great vehicle. And like I said, it's not every deal. It's not something you should be doing for every deal, but if there's deals out there that present themselves to one member of K2R, maybe you should share with the membership, and maybe we can put together a limited partnership and go after that business. So, okay, any questions?
Could you elaborate on what you just said about going after?
I'm sorry?
What you just got done saying?
Oh, okay. What I'm saying is that, let's say if we have a multi-unit building offered to us, and let's say one of you was offered, quite frankly, maybe what we should do is put together a group to form a limited partnership, depending on what cash you need, and fall in one of the exemptions and raise that money and buy the building. I think as you grow in the real estate area, you're going to get away from the single families, because you're going to go into the multi-families and the commercial, and that's going to be a natural progression, because I've worked with real estate investors for 35 years, and a lot of them that are in it for the long haul, they're all in commercial right now. And but a lot of times when you get a big deal offered to you and you're one person, I mean, the beauty of this is there's no investor here that should feel like they're an island. We're a team here, and we should all join together and present it, to call Chad and Scott and say, I came up with this, I have this deal, maybe we can put together a limited partnership, raise the money, and basically deal with it in that fashion.
Yeah, maybe get up with Wayne. Just because Wayne, what we put on yesterday in the city, Braverman was here, Michael, I should call him. He's really impressed, sent us a nice letter this morning. It appears we're going to be getting a lot more houses and a lot more blocks coming. Chad and I are going to be meeting with the mayor. Talk about
everybody in here should see the
clusters that could happen.
Wayne's talking about a multi-unit, but everybody's seen the concept of a cluster this weekend. We've actually physically walked through the clusters. Duncan Square is, Oliver is the most mature cluster that we've seen because obviously there's been 19 properties sold in there. You also saw TRF, the reinvestment fund from Philadelphia. The idea of TRF, it's a nonprofit organization, but what they do is they basically go out, find investment groups like us, put money into a pot, and then they go out and do large-scale projects. The idea behind what we wanted Wayne to talk about limited partnerships was because we've got the opportunity to get blocks and blocks and blocks of properties from the city of Baltimore. Braverman's behind it. You heard the CDC last night. You heard Chris Ryer out here talking about it as well. We've got the opportunity right now, a massive group of people sitting in this room right now, rather than each person going out and buying a property here, another property there, and a property here, and us coordinating individual properties for individual investors. The goal here is to start to design a partnership where we can all invest into the partnership. We can go out and start doing the development the way the TRF is doing it. Instead of going out and doing an individual property, we'll go out and take over the whole entire block. You saw what was going on in Duncan Square today. You can see how we talked the city into knocking down that whole row of properties. Now you've got 11 parking spaces there. You're going to have a little bit of a walking park there, and we're going to go through and take care of that. Last night, the people that came up that have property on Whitridge, we had Linda Dubbs, we had Matt Feast, his family, Carl Norton, you've got properties on Lorraine, Mike Yarsh, you've got properties on Lorraine as well. And the intersecting block of that is Greenmount Avenue. How many people went on our field trips and went on Whitridge, went on Lorraine? At the end, I don't know if anybody can remember, but at the end of the block, I know whenever I was in with some of the people who were in the vehicle with me, we drove down to the corner where Greenmount was. When we got to Greenmount, I always joke about it, we call that Hollywood because it's just a facade of properties because there is no back to them. It's just front end properties. Well, I was talking with Michael last night after he did his presentation, and he came up to me and he said he's got a huge amount of money that's allocated to whatever he wants to do with it right now. And if we want to take on the Greenmount Street and we want to turn that into a cluster, he's willing to put all the funds that he has towards his budget, not all of the funds, but a majority of the funds towards his budget to go out and demo that street for us. Now we wouldn't demo the whole block, we would demo all the back that was remaining, we'd have the front facade that was up, and then we could build out, we could do multi-units, we could turn this into commercial, there could be 3-4 unit apartment buildings in each one of those. But the idea of this is, it's really difficult to coordinate a one-off and one investor per property type of thing, but if we put the group together, we build this limited partnership, and then you've got other opportunities there as well because you're going to have some investors that are going to put a larger portion of money in. Some people that have the capital to do 100, 200, 300, $500,000 into the project, and then you're going to have other people that have $25,000, $50,000 smaller portions. Nobody's excluded at that point. You just get your percentage of however we write up the operating agreement and the way that the limited partnership's put together. We run as the general partner. We obviously have the control of how to run the projects. We're going to take care of the acquisition. We'll take care of the redevelopment. We'll take care of the timelines for getting it rented out or getting it sold and marketing it and doing everything. You guys just sit back as the silent partners and wait for the projects to be completed and get your monies returned. And then, of course, we'll have something worked out where we can take the next cluster on to the next cluster and on to the next cluster. So, and not only that, but to present that to the Bravermans of the world, to the Mayor Rawlings Blakes of the world, it's much easier to go in and say, look, we've got a limited partnership behind us. We have X number of money that they've committed to investing into this. What can we go out and what can we accomplish with you guys? So that's kind of what our vision is of this moving forward. We obviously still have the individuals. I know everybody likes the whole idea of owning their own properties and renting their own properties and having their own individual opportunity to do things. But when we do these larger scale projects, it only makes sense to wrap it into these limited partnership type of operations where we can go out and do a little bit more. It's more coordinated, it's much more efficient that way. Any questions on what we're thinking with that yet, Tim?
If you would become a member of a limited partnership like that, how would I be able to pass it on generationally, and if so, how?
Yes.
Yeah.
Absolutely. It's just like owning an interest in common stocks or a limited liability company. By will, you would bequeath it to whomever you'd like. So,
A specific item in the will that says this?
No, generally, it could pass under the residuary clause of the will too. That you leave everything to your wife, or if she's not alive, I leave everything to my children. But yeah, no, it would pass, just like any other asset. But what I'm saying is, one of the things I addressed there was that one of the provisions that we could put in the limited partnership agreement is deal with death. That the general partner would, if something happened to you, we would cash you out at death.
Yeah, there's provisions in the actual partnership that we all agree to when we go into this. It'll talk about, you know, selling of your partnership shares. What happens if there is the incident of a death, or if you want to get out of the partnership, or if you want to bring somebody else into the partnership. Those provisions are all written out throughout the documentation. Yeah, Bob.
Would you put your money into this limited partnership, you would, you know, 100 apartment complex or something like that?
Sure.
Say you put in $50,000, would the limited partnership then finance that, get a mortgage on that whole thing, and then you get $50,000 back out, or
Good question.
Or does it stay in?
Yes, it depends. I mean, it depends on the deal, depends on how much leverage it is, what you're trying to accomplish. It could go either way. What we would do is, a lot of times we leave that decision to the general partner. A lot of times, sometimes we go into these deals with cash or with financing up front, and then equity over top of it. Sometimes we go in and basically we finance it down the road. But it depends on the structure of the deal. And a lot of this is internal rate of return analysis. In order to get investment money, you're trying to shoot for a certain goal, and whatever it takes to get to that goal.
Just so everybody, I know what your minds are thinking right now. Well, I want to do a flip, I want to do a buy and hold. Let's just add you another third investment in your portfolio that you can be doing. You know, well, geez, I got that $20,000. What am I going to do with that $20,000? Well, if we got a bunch of us doing this stuff, somebody's putting in $1 million or $500,000 or whatever it is, it gives you the opportunity to have that other part of your investing going.
And know what else, Scott, is that, you know, sometimes people with self-directed IRAs, and I'll defer to Carl on this, but an LP interest may serve as an investment alternative for their self-directed IRA.
Yeah, there's different vehicles for it. Obviously, we wouldn't put a limited partnership on going out and doing a single-family home. I mean, obviously, 100 people sitting in a room investing into a single-family home, everybody would put $10 in or $100 each. It makes no sense for that, right? However, if we're talking about going out and doing a cluster like Duncan Square, I mean, the complete cluster in there is 46 properties. Rather than having to try and find 46 investors to agree on the 46 properties that each one's going to get, we can say, look, let's just put it all in here. Let us take care of all 46 properties. Then you have a percentage ownership in the entire project, whether it's a buy and hold, whether it's a flip, if we want to get financing. To Bob's question, when you had asked, what do you do? A lot of that determines on how much capital we actually raise in the beginning. Wayne had mentioned our project that we were doing in Detroit. That was all liquid capital. That was all cash investment from working capital that the investors put in. We went in and we started buying 15 to 20 properties at a time. We raised around $500,000, and we just went about it in that fashion. Get the properties bought, get the properties rehabbed, get the properties rented out, turn around, the next step would be refi, get their money replenished, pay everybody their return, and then do the next phase. If we raise enough money to go out and not get financing, obviously the returns are better. If we get the opportunity to get financing with the money that we've got, and we only have to put 10 or 20% down, we get a commercial space or something like that, well, leverage the 80% of the bank's money. If we're getting a good rate and it's going to give us an opportunity to do a larger scale project and give us the opportunity to make more money, well, we'll do that. So that's a give and take, and there's different opportunities and different ways to do this. But this is obviously for large scale stuff. This is not going to be individual properties here and there. This is we're talking hundreds of thousands of dollars, if not millions of dollars, that we want to raise together and put together and go out and do larger scale things. And this is going to be community. I mean, what we're talking about with the clusters, this is a community plan. This isn't rehab this property, rehab that property. We're going to be talking, there's multiple avenues we're talking with. We're meeting with the banks on the front end to see what we can get with them. We've obviously talked with hard money lenders. Those guys are interested in what we're doing. The properties themselves, the investors, you guys know what's going on with that. But we also have the city involved. When Keith was showing you guys Duncan Square today, I mean, to tear down, to work with the city and say, look, we'll take care of these 15 properties across the street, but you got to agree to us that you're going to tear down these 11 properties. You know, this group will put the money in to do that as long as you back us and do that on the other side. So it gives us a lot more leverage. You know, money talks. I mean, let's face it. This is life, and money talks, and everything else walks. So when we go out there and we can show them what we can do, it opens up a lot of doors for us. Any other questions about the clusters, partnerships, how to get invested into it? Is anybody in here involved in a limited partnership right now? Anybody gotten into that before? How did that work out for you, Paul? Are you doing it, what area?
We have property, actually we inherited from Virginia.
Okay.
And the only downside is that the general partner controls it, so we're locked in until they sell.
Yeah.
It's working very well.
I mean, and I know whenever Wayne was talking about the general partners, just to address that.
Paul, is that your family doing it?
Pardon?
Are you doing it with your family?
Yeah.
That's your problem. Let's be honest, that's your problem. It's the brother, it's the aunt, it's the uncle.
You do have to give the general partnership ultimate control. The reason being that if we all invested and we all had equal say in the deal, I mean, nothing would get accomplished. I mean, it would be a failure right off the bat. So somebody has to have ultimate responsibility for decision making, and that comes down to the general partner. Typically, you know, how we run our partnerships, we obviously, you know, it's just like any stock or anything. You're going to have investors that have an interest in this, so we're obviously going to try and satisfy the investors, because what we want to do is move to the next deal and keep the money into the next project that's going on. So although we're making the ultimate decision, I'm saying if we're going to structure this, I would assume we would be the general partners, because we're going to run all the projects to begin with. If we're the general partners in it and we're making we're going to make the decisions, we're obviously going to have your interest at hand whenever we're making these decisions, because obviously your money is what's going to keep these projects going, and to keep you satisfied is the only way we're going to keep the projects going. Yeah, Tim.
Is that a situation where the general partner doesn't make money if the limited partners don't make money, or what recourse do the limited partners have if the general partner starts to get sloppy and things start to go awry?
There's going to be a provision in there that talks about the ability to remove the general partner as well. That's different negotiations per different project as well. Obviously, there's a risk in any investment that you put your money into. The limited partners don't want to lose money. The general partners want to make money. I mean, we're all in this game to make money. So risks are involved, but the mitigating factors are putting these things together. It's not like we're going to say, give me your money, and then we're going to go out and you're going to find out later what's going to happen. Yeah, that's called healthcare. We don't do that. That's a different project.
We have to read the contract and find out what's in it.
But generally what happens though is if the limited partners are not making money, the general partners are not making money.
Right.
So you're in it together.
It would have to be that way, especially if the limited partnership has a limited role in the initial outlay of capital. If the majority of the capital, as you were talking about, Wayne, comes from the limited partnership, like you did in Detroit, the general partner's main focus is management, and really they're not focused on so much on whether they're making money or not, because the initial investment is not really there.
Sure, but they don't make money if the project's not making money.
That's what I was getting at. One of those where if we don't make money, you don't make money.
That's right.
That's exactly right. That's exactly right.
Yeah, and so what I was stating earlier was that in terms of you have to look at where the money's being made. A lot of investors want that annual return, whereas maybe the general partner is looking in the long term and saying this building's worth $1 million today, but could be $2 million in 10 years. So they're willing to wait and take a larger cut of it at the end, as opposed to taking the yearly interest.
And like Wayne has said, you know, one of the options for a partnership is 2/3 goes to the limited partners in the beginning, 1/3 goes, you know, during the cash flow situation, and it flip-flops for the sale. The whole idea behind that is the general partner is going to be focusing on building a strong investment, because he knows the real money is made in the sale, and the money that's made in the sale is based off of the financials of how strong the property is actually cash flowing on a monthly basis. So it's in their best benefit, their best interest to actually make it successful for the limited partners to get it to the end. Yeah, Jim.
How is this different from a real estate investment
I'm sorry, I couldn't hear you.
From a rate. How's this
Yeah.
From a rate?
Yeah. Well, you know, in terms of a trust is a different instrument altogether. I mean, it's but the concepts are similar. The trustee controls the REIT, but there's greater control in the general as a general partner than the REITs.
Yeah.
Is there any kind of provisions within the agreement on how long the investor has to stay invested?
Sometimes the agreements we drafted are you have to be in for at least 4 years. Other times there's no restrictions. It's a matter
You
of.
should not do it based on your age. Thanks, bud.
Jeff.
What's the time frame on establishing something like this? It sounds like the Duncan Square is going to be.
Well, phase one of Duncan Square is already it's established. The money's already in place. The city has already identified the cluster, and phase one is there's no room. There's actually one property that's left. We wouldn't obviously set up a limited partnership for that. We're waiting on a short sale to go through. We might put somebody in that on an individual basis. But there's a phase 2, a phase 3, and a phase 4 to Duncan Square, and that's where what we're talking about can actually take place for us and really get some get some teeth into it. When we showed you guys the first cluster day at Eager Square, Eager and Eden, most likely we're going to probably do those on an individual basis. But as we start to move over to the Carolines, phase 2 and phase 3 of what we're calling Eager and Eden, which is really just a progression. It's not really in that cluster. It's really moving more towards Hopkins to get to the Broadway cluster. Wish we had a map here for this presentation, but imagine Hopkins is kind of right here, right? What you have is we were at Eager and Eden up here on the northwest side of Hopkins. Then as you move a little bit further east, you've got the Caroline cluster, and then you've got Broadway. That's the two. The north and south strip to get into Hopkins. We actually drove one today and then we turned in to go in through Hopkins, if everybody can remember when we were on the trip. That whole entire strip of Broadway is very, as far as politically speaking goes, it's something that the city wants taken care of. It's a huge undertaking. I'm talking probably $15 to $20 million worth of construction that has to happen along just that corridor of the Broadway north and south. What we, if individually we can work with the Eager and the Edens, we can work with the Carolines, but once we hit the Broadway and we want to start executing that plan, we need to bring in this group, we need to bring in another group as big as this, and we need to put some money together so that we can start effectively taking care of the Broadway corridor. And not that, because you have to take substantial amounts of Broadway to do that. There's been a huge plan. We've been working on it with Keith and the rest of those guys. We're working on it with the city as well. But the plans are in place, but the initial capital to get that thing going and not have it fail right off the bat, it's going to be a tremendous undertaking. So we have to raise a lot of capital to do that, and we're actually working with banks and some other things to do that. So that's kind of one of those down the road types of investments. But the quicker we can get the clusters, or the quicker we can get the limited partnerships up and people going into those, the quicker we can get into those opportunities and make them happen. Setting up a limited partnership doesn't take long to do that.
I just had a quick thing to say about it.
Let me just introduce, this is Casey Lafferty in the back. What we do, and the gentleman to the left of him is Gene O'Brien, very good friends of ours, good investors. Gene has been a great advocate of us for a very long time, very successful investor in Philadelphia. Casey kind of does everything. He's got a construction company, he's got a brokerage, very strong investors from Philadelphia area. They are very interested in what we're doing down here. Basically what we do in the Baltimore area, these guys will be our equals or our counterparts in the Philadelphia area. They want to come out and see what was going on out here with the Baltimore area. So very knowledgeable individuals, have a lot of great input that they can bring to this.
The biggest advantage that hasn't really come up, I hear a lot of questions about the limited partner and having the general partner, I don't know, take advantage of the situation. The biggest advantage you're getting out of this as a limited partner is you're only liable for what you have invested. The general partner has unlimited liability. So start thinking about, if you have 100 units or a commercial strip center, you got to start worrying about Fair Housing Act. You got to start worrying about Americans with Disability Act. You got to start worrying about things that you really don't know if you have any control over. It could be a perceived issue. Someone could sue you based on Fair Housing Act, based on a perceived discrimination, even though you didn't do it. The general partner is unlimited liability in this situation. You only have the liability of what you've invested. So if you've invested $20,000, if someone sues the general partnership or the limited partnership for $5 million under the Fair Housing Act, you're not liable for any of it. The general partner is. That's the biggest advantage in all this.
Yeah, we're not doing that anymore.
That's
That's individual houses, cluster stuff, let's go break.
That's why Casey's always only a partner.
But I mean, that's the way you're going to start thinking. As you get bigger and bigger and bigger, more of your own capital is going to be involved in this, because there's nothing you can do about it. You're going to be making a lot of money, and you're going to have a lot of money sitting around, and you're going to want to reinvest it into these companies. So as you're reinvesting your own money, now your own money is out there, it's at risk, it's on the street. You want to protect it from God knows who's out there looking at it. This is a great way of doing it, because they're going to go after the general partner. They're not going to come after you as a limited partner, because your liability is so limited.
Plus, when you're hearing these guys talk, and what you're looking at and say, well, this side of the room's looking at this side of the room, we got 100 people. Well, there's about 100 or 200 that couldn't make it this weekend, just because the weekend it fell up. Okay? The word's getting out. Wayne probably handles 80–90% of our clients. Obviously, Wayne's proud of what we built. Think about that. It's not just this room we're talking about. There is a lot of investors that Chad and I have touched over 7 years now that have millions and millions of dollars. 2 of them we're having a meeting with this next week once he gets back from Acapulco, wherever he's at, Puerto Rico. This is the opportunities that we can marriage people up in the projects that make sense. And we've got the opportunity to Wayne to look at making sure the numbers that we say are accurate. There's a lot of avenues that we can do with Keith. You guys, he'll be here around 3 o'clock. So it's not just this group when we're talking about that side of it. We can put, literally there's 5,000 numbers if you take it from Miami all the way up. They're calling us. They're liking they like the new program. They like what this is all about. We're serious about it. So think big and think, yeah, you're going to get your deals this weekend. You're going to get your clusters. We're not going to stop, right? What else can we do? How much more money can we make? And change the face of neighborhoods at the same time. That's why the mastermind meetings are becoming a lot more important and a lot more. We don't have those wholesalers in there, the hacks in there saying, and then you're going to end up getting ripped off or something else is going to happen. It's a strategic planning that we're doing every Monday. And this weekend is what it's about, along with having a little bit of fun and learning.
Scott, as Casey indicated, that you are concerned with the unlimited liability of the GP, but as I previously stated, is we generally set that up as a limited liability company to try to couch that. And remember the example of the investors that we were raising. One of the investors that is putting up $50,000. Obviously, he's looking for a return, but he doesn't want, as Casey points out, a liability greater than the amount that he originally invested. So it's a perfect marriage, if you will.
These clusters that we've identified so far, as they progress through their phases and we start to identify and work with the city and get more and more clusters as we spread out and develop more areas, how much competition versus cooperation do you see between us, TRF, the other organizations? That is it becoming a competitive nature between different organizations?
It's actually the exact opposite. It's becoming more of a cooperative.
That's what I was looking for.
It's becoming way more cooperative. As Keith mentioned, he talked about the TRF. If you go north of Broadway, when I talked about the Broadway strip, TRF has already identified what they're going to do up. Broadway goes north and south. You got North Ave at kind of like crosses. That's where what we determine the end of Broadway. They've already identified a project that's going to happen up on the northern end. There's a couple things have to happen politically before they start announcing what they're going to do with it. But they're actually at the table with groups like us right now talking about working together to do this. Now you've got the not-for-profits and you have the for-profits sitting down at the same table talking about doing things. We also have Habitat for Humanity, who, I know I've had some side conversations with a lot of people, but when they looked at us, we were the capitalist pigs that, we were dirty because we wanted to make money off of this stuff. They never wanted to do anything with us. Well, the tables are turning and down here and in Baltimore, and a lot of these groups are now realizing that if we put our efforts together, they don't have to make money, but they can certainly make the impact that they want. They can do it at a lot cheaper price because we're more efficient at doing our project. A build out for Habitat for Humanity probably costs anywhere from $120 to $130 or $150 a square foot. We're doing the same thing, the same footprint for $70 to $100 a square foot at worst case scenario. We're blowing them away, and these guys have free labor. and they can't beat our build-out price, because as investors we have to figure out how to make it efficient, how to make it cost-effective, so that we can actually go out there and be successful at it. These guys see this, and it was basically an accident. One of the guys was driving around with somebody from Habitat for Humanity, and they were talking about one of the build-outs they did, and they just happened to mention the build-out price that was what, and he was like, "How did you get it so cheap?" And of course, he went through the financials of how he was doing everything, and they realized, what are we doing wrong over here on our end? We're spending way more money to get the same effect that these guys are doing. So if we work together, figure out who's good at what, maybe we can make this thing a much bigger and more effective process.
We had some experience working with them. They built a project right next to one of our properties in Reading. And today they make great neighbors, but it took that initial contact and it brought it on because my property manager went to check the property and said somebody drove a cement truck through my yard to get to the rear of the property. Right. And I found out who to call, and the guy was very cooperative, went out and looked at it. He said, "Oh geez," he said, we already had access with a restaurant through his parking lot in the back. I don't know why the heck the cement truck driver drove through the yard. We'll take care of it." I mean, they were a pleasure to work with, and today the people that are in those houses are wonderful neighbors. When I have a tenant move out, they watch the place like a hawk.
Yeah, the groups are coming together to do this. The city's behind it as well. You have non-for-profit, you have quasi-governmental agencies, you've got the government, the public organization, and the private sector all working together in this. And you get all those pieces together, you can have a really big impact.
Just a little more on the limited partnership. Okay, Casey, right? What's more important, the project involved or the people who are proposing the general partnership? In your estimate?
In my estimation, I would say the project itself. I'm looking at the bottom line. If I'm going to put up money or we're going to get to a project, I'm going to know what the return's going to be, and the partnership agreement is going to lay out how we're going to get to that. So,
the project's ultimately going to be the decider of whether you're going to make money or not. The people are kind of, irregardless, if we got 3 people and, it doesn't matter if it's number 1, number 2, or number 3 that puts the money in towards it. The money's the same amount either way. So the project's what really, is going to be the inhibitor or the one that's going to make the project successful.
Well, the project drives the deal.
It drives the bottom line.
Absolutely.
Yeah. We good? All right.
Okay.
I'm actually gonna thank you, Wayne. Appreciate you coming up here and talking about this. We're on the Capitals. There's nothing wrong with that, right?